Welcome back to the Behind the Wealth Show. I'm your host, Roger Abel, with Elias Randel here in studio. How's it going, Eli?
It's going.
So hopefully it's going to thaw out one of these days. We had, 88 hours below zero?
That sounds like a lot. I have no idea. I don't even know how you know something like that.
You weren't on radio on Monday, were you? No. Doug Wagner gave us.
Doug talked about that?
Doug had the statistic. Yep. Did you happen to watch the KCRG show yesterday, Everyday Iowa?
I did not.
So you didn't hear about my little dig on Justin Roberts?
No. What was your dig on Justin?
I told him he was right 20% of the time.
Why'd you say that?
I don't know. We were talking about something. I said, well, you're only right 20% of the time.
Did he like that?
He
Did
got
he
a
think
giggle.
it was funny?
Apparently, when I left, he said, and when we come back, we're going to get a public apology from Roger, and I know what he drives. He thought it was funny. Yeah, it was all good. We were talking about something. I'm like, well, you're only right 20% of the time. And then I ran into Joe on the way out. I said, hey, go tell Justin I told you you're right 60% of the time. And he knew what I was referring to.
Jeez.
No, it was pretty funny. I got a couple people reached out and said they appreciated that. And
They
said,
like that?
Yeah, they said, I like that. And guess what? You're right.
Yeah. What do you think people would say if you said that to Doug Wagner?
That he's only right 20% of the time.
Yeah.
I think Doug would argue with me about it.
Try it.
But he's not a weather guy. He's just throwing out what's happening.
No,
He's
Doug's
not,
an everything guy.
he reads a lot. He does know a lot about a lot.
Yeah, he's an everything guy.
Yeah, I think Doug's right more than 20% of the time.
I have no idea. I've never thought about it.
But just the weather guy. I'm like, this is the only place I'm like, well, guess what? You got a 50% chance of rain today.
Justin Roberts, he's a meteorologist too.
He does the weather. I don't know if he's really a meteorologist, but he's reporting the weather.
He'll report it on their show.
Yeah.
I bet Joe Winter does all the work. Right? He's the main guy, right?
Yeah,
so Justin's probably just presenting the stuff he gives him.
For sure.
Yeah.
For sure. Yep.
I don't know. 20%'s better than zero.
Just think about that job. It's great. Just tell someone what's going to happen. You got a 50% chance of rain. You're right all the time, really. Well, it did or it didn't. In the middle. It's just mid.
Well, they're looking at patterns.
I know.
I don't know what people expect from them. What do you expect?
With today's technology, I think we should be able to dial it in. I'm totally joking.
Seems pretty dialed in to me.
I'm joking. Hey, we got another first, though. 7,000 on the S&P 500.
Yeah, did it close at that? It traded above that.
I think it went. It didn't close there. Closed just below, but it went up to $7,001. I don't know, and it's off today, so I don't know. It might go, but well above 7,000 by the time people hear this. But that's kind of big news. Every time I see the stock market keep going, can I tell you who I think about all the time?
Tom Lee.
Harry Dent. I'm just wondering where he's at.
Where?
Yeah. Is he still in Puerto Rico?
Probably going to be on.
I thought he said he was going away.
He's probably going to be on CNBC today and talking about the biggest crash of everyone's lifetime. And
well, this just goes to show that you can't predict this. And even though there may be things out there that scare people, you don't really know what's going to happen. We may very well get a correction. We probably will get some kind of a correction. We average a 13% drawdown annually. Tom Lee thinks we'll get a correction of some kind this year, but that's not really a bold prediction. I don't really
know why you wouldn't think that. Like, what would stop you from thinking that?
Well, you shouldn't. The average drawdown in the market's a little over 13% each year. And it comes back, finishes 80% of the time positive. I think the dispersion of returns chart that we talked about a couple of weeks ago is actually just a really good chart where the vast majority of the time the market's making well over 12%. I think it only finished down greater than 26 times in the last 100 years. Is that right? I think so. 5 or 6. And that's what everybody's fearful of. So you're fearful of the 6% of the time.
And it's temporary.
It's temporary.
It's never been a permanent loss.
Well, and
unless you sell, but like anyone who has held their portfolio done the right things, even when it gets hard. They haven't experienced any losses. That's all. The fluctuations are always temporary.
Well, people talk about how overheated it is, right? Like, oh, the market, it's all-time highs. Well, do you know what the cumulative 4-year return is?
Right now,
Yeah,
no.
the cumulative 4-year. I believe the cumulative 3-year, 67%.
Okay.
But remember, we lost 24 and 22. So if you do a cumulative 4-year return, it's 43%. So right at its historical average.
Yeah, we're close to the trend.
We're right on the trend line.
Right.
So that's where, you can't just just reach out there and say, hey, the market's overvalued. It went up 3 years. It goes up 80% of the time. And I talked to someone the other day and I said, it's not once again, all-time highs aren't laws in the market. It's feature. But that said, if you're concerned, then now's the time to reevaluate your portfolio.
Yeah. You probably ask yourself, what's causing all this concern?
I would say most people that have that haven't really sat down and figured out what their risk capacity is and what they need to do to be financially successful and accomplish their goals.
Yeah. I just met with someone who has been in cash since 2020. So they got scared during COVID, went to money markets.
And now they want in.
Never got back in.
Do they want in now?
Yeah. Yeah, they just feel like they've made a giant mistake. I'm not going to point it out to them, but that's huge. Like, yeah, that's huge.
So what did you
cost yourself a lot of money?
I mean, that's a double and a half.
What did I tell them?
Yeah, I want to know what you told them. What was?
Moved on to the solution. No point in talking about the past.
Yeah, I feel bad for those.
I'm not gonna rub their nose in it. Make them feel worse about it.
No, I understand, but I guess from a psychology standpoint, I'm thinking about you have a person who is so scared they sat on the sideline for 5 years. Now they're jumping in. What's their reaction going to be if they happen to jump in and it goes down 13% in the next 4 months? Like, how did you mentally prepare them for that?
Well, that's going to be a process. But based on our first conversation, they're ready to be an investor and not try and time the market.
How old are they?
He's 58. And this isn't really that detrimental of a mistake for this guy. Like, he's cost himself a lot in opportunity costs as far as returns he missed out on, but he does not need. He's someone that doesn't need his investment accounts for income.
Pension? Does he have a pension?
Well, he's self-employed. He's a horseshoer. I don't remember the technical name.
Blacksmith?
No, it's like a furring or something.
Okay.
Furring. But a horseshoer. He's got a really nice niche business, helping people with really big barns and a lot of horses. So he's going to scale back his clients and just keep a couple. And he told me if he works 2 days a month, he can cover all of his monthly expenses. So fairly frugal person. So I think psychologically that's probably part of it is he doesn't need to have any sort of big gains in his accounts. He's not really planning on using it for income. He's going to semi-retire, so keep working in his business a little bit, but just scale back a lot. So, but according to him, he said, I think it's just time for me to kind of turn it over and just do what I'm told, basically, is the way he outlined it. So if he can commit to that, then I'm sure it can work out.
That's the mature thing to do. Like, you made a mistake. Figure out how to fix the mistake and find someone to help.
Yeah.
Like, I think
he acknowledges it's a mistake, but it doesn't really impact him. So he doesn't really care that much.
Well, here's the thing, though. I think there's probably a lot of people that have made that mistake that aren't willing to admit they made the mistakes. They're embarrassed. They definitely don't want to go ask anybody for help. They don't want to show up somewhere to a financial advisor and say, hey, yeah, by the way, I cashed out in 2020 because they feel like they're going to be persecuted because of it.
I agree with that.
I think you did a good job not making them feel bad. And I think that's the take we always have on this is, hey, what's in the past is done. You can't control it. So what's the best path forward? Right? He could have been perfectly right? There is another outcome. Unlikely, but there could have been another outcome where he was right and then he felt really good about his decision. But history kind of shows us over time, market continually grinds higher.
Yeah. So you can't go back. I mean, would I really enjoy to go back in time and help him make a better decision? Yeah, but that's not one of the options that's not a path to the resolution. So just got to move forward.
And I think in all fairness to COVID, it was a little bit, it was a lot different than most market corrections.
Yeah.
Just a lot different, like really something nobody had ever seen, or the world just shut down.
And no one knew how long it was going to last.
Right.
And
so if someone got scared, I completely understand.
I guarantee he's not the only person out there that.
And honestly, people were calling here. They said, how long is it going to last? And our standard answer, I don't know. It happened so fast, though, people didn't really have a chance to get out.
Right.
They all the bottom.
Right. And then once, I think after the Fed announced they're going to take the interest rates to zero, then I think people piled in, or at least institutions did, but there was money going to stock market after that.
Well, and a lot of people bought real estate and just assets with it. And I was reading an article in Forbes actually talking about this. And as baby boomers age and they start to transfer their wealth, there's one thing that's getting transferred to the next generation that's maybe not a bad thing, but it's not necessarily easy to deal with. And I think when we think of wealth transfer, we inherently just think of cash and stocks and bonds going to kids and grandkids. But for most people, Elias, that's not their largest asset. Their largest asset's their house. And most of the kids aren't taking the house and living in it. So then what happens? This becomes a little bit of a liability from a work standpoint, especially if mom and dad didn't downsize and they still have everything that they accumulated throughout their life.
You can accumulate a lot of stuff over 30, 40 years.
I look at the amount of stuff that we've accumulated. And I then think of my kids, I'm like, how would you get rid of this? Like the amount of fishing and hunt, like all this stuff I have, they need an auction. And they're like 9. But then add another 40 years onto this. Well, hopefully I get 40.
Will people let you do? Can you have an auction at your house? Just start over. Hire the auction company to come in and just sell all the crap.
Put her in the driveway, just start auctioning the street, just start selling it. But I like all my stuff. I don't want to get rid of it. So my mom has a massive collection of Christmas decor and ornaments and snowman stuff. She loves that stuff. And I remember they sold a house and the realtor asked him to take down some of the decorations because it was becoming a distraction. And I know my mom's going to listen to this. I'm probably going to get in trouble. But she goes, someday this will all be yours. And I said, it'll all be on eBay real fast.
You shouldn't have said that.
She wasn't thrilled about that. But, that's the reality. The reality is the stuff that's important to me and what's important to you and what's important to my parents probably is not that important to our beneficiaries. Sure, there's some like memento items, but I think my girls are going to care about how many megabass jerkbaits I have for fishing.
If they get into fishing, they might.
Nah, they're going to say, hey, $30 a crack, let's sell them all.
Well, you could have that too.
There's a lot of them.
You could have that too. Yeah, I don't know. I don't know. So this article here about people inheriting a house, it feels like work when you inherit your parents' house. That's what it's getting at.
For sure. Like you just think about the massive amount of work when you go into someone's house, for instance, and just simple stuff.
Just offload it. Get rid of everything.
People won't do it.
Sell the house.
They won't
move
do it.
on.
So think about your parents' dishes. Not like the family's nice china, but your mom's dishes.
What dishes?
Like just their regular stuff they used to eat on.
Okay.
You're going to get rid of all of it.
Yeah.
You're going to have to get rid of it. And the clothes and all the other stuff. Here's what makes me think about Elias. This is the exact same analogy. When I bought the lake house, it came fully furnished, dishes and everything. That wasn't a blessing. I had to get rid of all of it. My daughter's allergic to a dog, so all the furniture had to go. We got rid of, I mean, I don't want someone's silverware they've been eating on for 11 years. It's been passed through this house for 2 decades. Like, but down at Lake of the Ozarks, that's how they sell these places, fully furnished. Be like, oh, it's fully furnished. No one wants to move their stuff.
Yeah.
Like, it's not. Now, when we sold it furnished. It was all pretty nice stuff. My wife was a little upset that we left all the furniture. But most people are literally leaving junk.
You're making me depressed.
When we moved in, when we bought the condo down there.
I know. You're making me think about all the junk that we have at our house. It makes me depressed.
Oh, me too. And so I think part of it is, if you're going to downsize, part of downsizing should be not just like the size of the house so it's easier to manage, but the stuff you have. Figure out what you really have to have.
This problem's only going to get worse too. Like, if people don't like inheriting a home now, well, homes have gotten bigger over the years as family size has gotten smaller and people have more discretionary income.
Just more junk stuff.
So there's just going to be more and more and more stuff.
It's like, our house, we're bursting at the seams. When we moved in there, we didn't have anything. Now there's just stuff everywhere. And
I'm a minimalist now.
Is your wife?
Yep.
I don't believe you.
As of right now.
As of right
we're
now, you're going to bring the dumpster in?
Yep.
We've done that in this office. Every President's Day, what do? Office cleaning.
Clean it
we
out.
Get rid of all the junk and drink some Bloody Marys, get rid of the junk. Then we go out for wings and happy hour.
Yeah, is that coming up?
February, I think. Molly wins President's Day. February 16th, Molly said. Yep, coming up.
Good.
Be a good day here. But just think about that. If you're downsizing, figure out what you can get rid of. But here's another thing I do see.
I have a question before we move on.
Fire. I'm moving on, but fire.
Are there any companies that will decorate like on a subscription service for holidays? I know they'll do. There's people that will come decorate the porch with like pumpkins and fall decor. But what about like Christmas decorations? Like, what if you had a big warehouse with all the decorations and here's our package. We come decorate right after Thanksgiving.
Sounds like you just have a new business, bud.
Do you think there's people out there that do that? I'm sure there are.
I'm sure there are. I've never heard of one in our area. I mean, we have the lights put up and the wreath put up every year. But I'm sure there's got to be a business. If there's not, it's probably a good niche. Because you could find
just
people.
A subscription to Christmas.
You could find individuals who really enjoy decorating for Christmas, would love to come to your house, make it perfect. Like, there are just people who want to set up a Christmas tree and put the lights on, and like, they love it.
Yeah, that would not be a good business for me. I
dread it. My job is to get the tree up,
No.
get the lights off, and the tree down. That's my job. All the ornaments, Megan and the girls do all the ornaments. I don't touch an ornament.
I don't do any decorating.
In fact, Megan had me get that tree out this year in October because I was going hunting. So she's like, I'll just do this when you're gone hunting with me and the girls, something to do. But that's one of the biggest, if you think of what takes up all the space in my basement, it's Christmas decorations, Halloween decorations, Valentine's Day decorations, Easter decorations, Thanksgiving decorations. It's all boxes of decorations. When we moved in, we had like a tree and a box of ornaments, and now we have a whole room, which is fine. But every year, you add a little bit more. The collection just keeps growing. Now we have bunnies and snowmen and Santas and all this stuff that sometime has to get taken care of. But one thing
I'm getting anxious just thinking about it.
Here's one thing I do think is important. If you have meaningful stuff that you want someone in your family to get, so let's say you've got some piece of china or something that's meaningful and you specifically want a family member to get it, you should make that known. Like, make that known to the beneficiary. I want you to have this. Because there are items that get fought over at, that time. So I think about my wife's grandpa. I was at my brother-in-law's here not too long ago, about a month ago. He was in World War II. And my grandpa had told Ryan he wanted him to have this stuff, or Megan's grandpa did. So he had one of those, the like knives they put on the end of the gun in war. So if you run out of bullets, you can like ram them. He had one of those from World War II. It was actually from a soldier. He took it off a soldier that had died in World War II, and he had that. And he had some other like pretty cool World War II memorabilia. But they made that known, hey, this is who we want to have this. If that wouldn't have happened, now you have a whole bunch of people like, hey, I want that, I want that. Made it very clear who should get that.
It's a good idea.
So if you're have a big house, you're thinking about downsizing, don't just downsize the size of the house, start downsizing the things and figuring out where they can go or get rid of those things. I know the last time we moved, we brought a dumpster in. So we moved out of our old house, we brought a dumpster to that house. So as we were moving and packing, what we didn't want, right in the dumpster. Because there's a certain amount of stuff that should get thrown away, you just haven't thrown away. The last financial thing let's hit here, Elias, before we get too far. Capital Group, one of the companies that provides some great research for us, for our industry, came out with the 5 charts you should know. And I think it's important to kind of cover what could happen in 2026. Tell me your thoughts on, let's just talk about chart 1. Bold stimulus could boost the global economy. What's your takeaway on this? And I'll take number 2.
I think this is important for investors to understand for 2026. There's a lot of talk right now. Oh, the market's back around all-time highs, so that means we're going to have a correction, and you're probably right. We probably will. You mentioned it earlier. All-time highs are a feature of the market. How'd you say that? It's
All-time highs are a feature of a market, not a flaw.
Not a flaw.
People look at it as negative. It's not. It's positive.
So that is a feature, not a flaw. And globally, there's our U.S. Federal Reserve and places around the globe want to boost the global economy. They're ready to prioritize growth over the inflation fear, certainly here in the U.S. So I think as they do some, lower interest rates, some tax reform, deregulation, these are all things expected to happen. That should boost the economy, which should be a good thing for the equity or stock market. And I think investors need to understand that. And that doesn't mean that we can't have a correction in the stock market. You should really I would just tell everyone, expect that to happen. Expect a correction to happen this year, and no, I'm not going to make a mistake if it does happen. Just tell yourself that right now.
Well, I think the second thing that highlights or underscores is that we're walking into a little bit of a dovish Fed. I think you look around the landscape, we're going to get somebody new in the Fed in May, likely. Jerome Powell will be gone. And I think the expectation is that they will likely lower rates as long as the numbers and economic data make sense. And one thing to understand is when rates go down, that's typically good for stocks and bonds. Right? When rates come down, bond prices go up. And when rates come down, it actually makes stocks more attractive. You're less likely to lock your money into some fixed income vehicle paying 2.5% or 3%. And I just went out while we're on the show here and pulled up FedWatch. It's a good place to go. That's put out by the CME Group, Chicago Mercantile Exchange Group. And it's the odds of where the interest rate environment is headed. Okay. And today, the rate's between 3.5 and 3.75. That's our current Fed funds rate. There's a 75% chance of at least one rate cut this year. So at least one rate cut. So there's not like 4 or 5 rate cuts priced in. There's only 75% chance of one, but there is a 50% chance of 2 and a 21% chance of 3 rate cuts, taking it down to 3. If that happens, that's likely pretty good for stocks and likely fairly good for bond prices too. So I think that's one thing that people have already been thinking about. They're out ahead of it, is that, hey, if we get interest rate cuts, that could be good for stocks and for bonds.
Right. And people are expecting one, basically, based off that. One or two.
We're expecting one. If we got three, there's only a 21% chance of three.
So most likely,
So most likely it's one, and it's a coin toss whether we get two. But that's so fluid, Elias. I don't remember how many they expected for 2025, but it was way more than we had. Like if you looked in 2024, I think they were expecting a lot more rate cuts in 2025.
I think so.
All the tariff, all the uncertainty really, really, really squashed that, because it was this is going to be inflationary. Tariffs are inflationary. Well, so far, it hasn't been inflationary. This past week's the first time we've really seen oil spike, and that's because of some of the stuff going on in Iran. But for the most part, I think the last CPI was 2.7? Like, we're not in this massive inflationary environment. Really, we're really back to about long-term trend. Like if you look at the historical inflation, if we utilized our financial planning software, which goes back to like 1970 or 80, it's like 2.68%. So we're running at trend. We're not at where the Fed would like it to be of 2, but we're still running on a historical trend line.
Well, and is there anything that says that? Why is 2 the target?
It's an arbitrary number.
Right. Because what if all of a sudden they said, hey, we like 3 better?
Yeah, they could do that. They could totally do that.
Right.
Other thing, the third thing to watch this year, our company profits are expected to rise. And a lot of it revolves around AI. Estimated annual earnings growth across the globe, it was in the U.S. was 11.5% last year. It's expected to be 14.9% this year. So that's a pretty good increase in overall earnings for companies. And if you think about how company valuations are done, it's based upon earnings. Stock price is a reflection of earnings of the company. Earnings growth, that's typically fairly good for the market. And I think the fourth thing people are really thinking about, we hear it every day, is artificial intelligence a boom bubble or both? What do you think?
I'm sure there's probably both. I'm sure there's aspects of it that are a bubble. I'm sure over time it's going to be the next thing that takes our economy to the next level and creates a lot of wealth for people. I'm sure there's areas that are a bubble. I think one of the because people compare now to the late 90s, right? I think one of the main differences I've been hearing even institutional people talk about is one of the big differences between the environment today and back then is the investment into the technologies coming from companies that have core business models that are profitable and make money, where back then all technology was very much speculative at that time. No one really knew how it was going to impact our life. There wasn't as much you didn't have like Apple out there that can go create a new iPhone and just make billions of dollars.
I think the difference too, how old are you in 99, 98?
10.
Okay. So I was in college when this went on. I was taking finance classes at University of Iowa. And here is the massive difference. And I wouldn't even call that era technology. Let's call it internet or .com. That era was similar to the meme coin craze. Like, oh, I slap .com on it and it's valuable. Remember in 2020, 2021, you put a coin out there and people buy it? I mean, it wasn't that extreme, but it was similar. Like these were companies that had no business model, no earnings. They just started a website and it's going to be profitable. That's like, to your point, that's not what's going on.
And there were businesses that became profitable on the internet, not all
100%. But if the big thing is, if you look at combined forward earnings of the company, they were decreasing from 98 to 2001. They're increasing from 2020 to present. So it means the companies that are doing this are actually getting more profitable, where from 98 to 2001, they were becoming less profitable.
So it's hard. Those errors are hard to compare. It's
hard to
almost apples
compare.
and oranges.
I mean,
There's a lot of differences.
AI is here and it's here to stay. How and where it goes, I think, is yet to be determined, but it is in the fabric of everybody's life, whether you know it or not. I mean, it's happening. I'm sure, like, I just watched a video on YouTube talking about IRS audits. They're going to use AI, and not to figure out like your year to year, but to benchmark you against peers in your industry or what you're claiming as your industry, and look for massive discrepancies. Like, oh, you made 70,000, but your payments are X you're paying 5,000 a month for these homes. How do you do that? Because now it can catch it. It's not a manual thing. They're gonna have AI to just cross check it all, and you know how smart it is. Be instant. So you're just talking about how, and it was kind of like the wake up call. Like, everybody thinks the audit industry is for wealthy people. This guy's like, it's gonna be easy for everybody to do it. I mean, think it's just a cross check. Oh wait, you're writing off and he specifically mentioned home office deduction. Specifically, because they can cross-reference now the square footage of your house versus what you're claiming. Because technically on that home office deduction, if you have a 10 by 10 office in a 2,000 square foot house, that's 5%. If you're claiming 50% is your home office, and it's massively outside of the range of people in your industry, that's a red flag.
Yeah, I wonder how many red flags are out there just around that.
I have never done
intentional or not.
I have a home office. I've never taken the deduction, ever. My accountant's like, you want a red flag? Take a home office deduction.
So then you just don't do it.
No, I have a storage garage I rent for some of my personal stuff, but I have business stuff there. I parcel off where the business stuff is at. That's all I deduct for it. I don't deduct the whole thing because I don't want a red flag over something silly. Right. So AI is here to stay. And what it does to the stock market, it's really unknown. But if we get companies that are grow their earnings, people become more efficient, it likely will continue to power the market. We're already seeing it this year. I mean, most of the stocks that are going up again this year, a lot of them are tech companies. And 5, I think this is the one that everybody should take away from these charts that we're talking about. If someone wants the charts, we'll have them online. But the theme is there's always a reason to not invest. And this goes back to 1987. And I could start to give the reasons why to not invest. And this is just a straight trend line up to the right, just increasing markets. In 87, you had Black Monday. 1990, 1993, you had a recession. 1990, you had the Gulf War. 91, you had the collapse of the Soviet Union. 98 and 2000, we had the dot-com crash. 2001, we had 9/11. 2008, we had global financial crisis. Like, all of these at the time were huge events. But if I pulled anybody today and said, how much would you have invested right the day before 9/11 started? Not after, the day before you knew it was going to happen. And you knew it was going to happen 15 years later. If you knew what today's outcome was, you'd tell me you'd invest every single dollar you had.
Yeah, everyone would.
Everyone would do that. So I think that's the number one takeaway going into 2026. We've had 3 great years. I mean, really great years in the market. Nobody knows what's going to happen, but you surely could find a reason right now why it's not a good time to invest. But if you look back through history, all of the times that we were scared and all the things we were scared of in the investing world turned out to be a very good time to invest.
There will always be reasons not to. I think we've talked about this as a firm for a really long time. I bet you could go find old radio shows we've done that. Here's all the reasons not to invest this year. Right? We've done that theme before.
Apocalypse du jour. We've been running this since like 2013.
Yeah. So I don't know. Maybe there's never a good time. You just have to, if you want to be an investor, then you have to do it.
You know, I think I do believe people are starting to understand that more and more. I've had more retirees tell me they want to be 100% equity. Like retired, be like, I don't want any bonds. I've had it happen 3 times in the last year. Like they're willing to have
they
a cash
just know
management.
they know there's going to be fluctuations. They just know they're not going to make a mistake.
They're willing to do it. And I have to push them and tell them to do that. We need to have a cash maintenance strategy. You need 3 years of cash.
Right.
Like at a minimum, if you're going to be all equity, you need 3 years of cash. It's not one. Like the people who get away with one have a little bit of fixed income in there, right? That
helps offset.
That helps out. Yeah. But I'm really adamant. If we do this, we need 3 years of cash in this portfolio. And we have people adding protection in other ways to the portfolio as well who do that. But I've just seen this, not massive, but the individuals that we're working with that understand the market, they just don't want to be out and they're okay with the fluctuation.
Long term, they've been rewarded.
You know, and I think about where those people are located. A number of those people are in Omaha. I wonder if that has something to do with it. Warren Buffett land, like, you know, be invested all the time.
I'm sure that influences their thinking. Yeah.
Yeah. I literally just thought about that because 2 of the individuals who have said that to me are in Omaha specifically. And I would guess that probably leads to their decision making.
Yeah. Well, and now cash management's different, but to just choose a portfolio based on age, like that rule of thumb that people talk about, as you get older, you can use 100 minus your age to figure out your stock to bond. Like that's such just a weird exercise to figure out how you want to be invested.
You know what's ironic about that? If that was actually reality, don't you think that's how target date funds would run? Like, isn't that how a target date fund would be run if that was the actual?
That'd be the easy way to do it.
Well, I can tell you, if you have a target date fund that's 2025, right, this year, most of them are 50% stock, at least 50% stock. Right. So if you're 65, that rule of thumb would say we need to be 35% stock. That is, if someone tells me that is absolutely just disqualification immediately. There's no part of that has any validity other than, think about that. So if you're 20, you're supposed to have 20% of your money in fixed income.
Absolutely not.
That's a bad one, you guys. That's a really great rule of thumb to throw right in the trash.
Yeah.
Well, with that said, we want to thank everybody for listening to the show today. If you have any questions, if you want anything answered on air, if you want to check out this guide, we'll have Molly post it, btwellshow.com. With that said, well, thank everybody for listening. Hopefully you tune in next week.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options, each choice offering advantages and disadvantages. Those options include leave the money in their former employer's plan if permitted, roll over the assets to their new employer's plan if one is available and rollovers are permitted, roll over to an IRA, or cash out the account value. Consult your tax professional about eligibility to Roth and traditional IRA contributions. contributions and earnings in a Roth IRA can be withdrawn without paying taxes and penalties if the account owner is at least 59.5 and has held their Roth IRA for at least 5 years. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of the conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA.